Hi, I'm Tom Field, Vice President of Editorial with Information Security Media Group. Welcome to today's webinar entitled Identifying Synthetic Identity Fraud. Your featured presenters today are Jeffrey Feinstein. He's the Vice President of Analytic Strategy with LexisNexis Risk Solutions, and is joined by Shirley Insko, Senior Analyst with IT Group. Now, before I turn this over to Jeffrey and to Shirley, let me give you just a bit of background on today's session. Fraudsters are increasingly turning to synthetic identities to commit application fraud. Synthetic identities wreak havoc on traditional validation and authentication methods, costing organizations time and money both. Are you ready to take a stand against synthetic identity fraud? In today's session, you're going to receive a detailed overview of the growing challenges of synthetic identity fraud, including identifying synthetic identity fraud attempts, strengthening fraud defenses with multi-factor authentication, mitigating synthetic identity attempts on the front end of a transaction, and minimizing onboarding impacts on legitimate customers. I do want to take just a moment to tell you a little bit about Information Security Media Group. We currently publish more than 24 international media sites. We have Bank Info Security and CU Info Security for financial services, Gov Info Security for the public sector, and Healthcare Info Security for the medical community. We also publish Info Risk Today about information risk management, Data Breach Today about breach prevention and response, and Careers Info Security. Each of these sites is dedicated to providing education and news regarding information security, but specifically tailored to their individual sectors. With over 750,000 members registered to our sites, we've created a true information source that tackles the key issues of interest to our unique audience. Just a bit of housekeeping, please. If you have questions for Jeffrey or Shirley during the course of this session, please submit them via the chat window that you see on your screen now. If any of you should experience any technical issues while viewing today's webinar, please dial the number that you see on your screen. If you dial extension 115, we do have technical support staff standing by to help. Also, I need to emphasize, the content being presented in today's webinar is copyrighted material. It's meant for today's session and individual study purposes only. If you or your organization would like to use any of the information presented in today's session, or if you're looking for customized training materials, please contact us. Let me introduce our sponsor today as well, LexisNexis Risk Solutions. LexisNexis Risk Solutions believes in the power of data and advanced analytics for better risk management. With over 40 years of expertise, the organization is the trusted data analytics provider for organizations seeking actionable insights to manage risks and improve results while upholding the highest standards for security and privacy. Headquartered in Metro Atlanta, LexisNexis Risk Solutions serves customers in more than 100 countries and is part of RELX Group PIC PLC, a world-leading provider of information and analytics for professional and business customers across industries. For more information, please visit www.lexisnexisrisk.com. And now let me introduce our presenters, starting with Jeffrey Feinstein. He's Vice President of Global Analytic Strategy at LexisNexis Risk Solutions and oversees domestic and global statistical development and analytic projects for financial services and related areas, government and healthcare markets. He's been a thought leader in risk and fraud analytics and credit bureau scoring for more than 20 years. Jeffrey currently leads innovation efforts to bring new analytic solutions, techniques, and content to the marketplace, and he particularly focuses on isolating data patterns descriptive of synthetic and other compromised identities, as well as enhancing financial inclusion opportunities for underserved consumers. We'll also be hearing from Shirley Insko, a senior analyst with IT Group, where she covers fraud, data security, and consumer compliance issues. She brings to IT Group 30 years of banking experience in enterprise fraud and payments issues. She served as the chair of the BITS Fraud Reduction Steering Committee and the co-chair of Early Warning Services Advisory Committee, and has been a member of ABA's Deposit Account Fraud and Payment Systems Committees. With that, let me turn you over now to Jeffrey and to Shirley. Folks, it's all yours.
Thank you, Tom. I'm going to chat this afternoon about the evolution of synthetic identities, and Jeffrey will talk about identifying synthetic identity fraud. At the end of our webinar, we'll have a question and answer period, and I welcome all of you to our webinar. When I think about a perfect storm, I think about a sailing ship being tossed around on huge ocean swells, being buffeted by strong winds. Or conversely, I think of a devastating hurricane making landfall and leaving destructive flooding in its wake. The perfect storm I'm going to talk about this afternoon, however, is a little bit different, and it's defined as an event where a rare combination of circumstances aggravate a situation drastically. From a fraud and identity theft perspective, there's a perfect storm on the horizon. In fact, many financial institutions are already feeling the storm's impact. For the past several years and continuing today, there have been numerous data breaches rendering personally identifiable information, or PII, email addresses, financial card data, and other information readily available to fraudsters. They use all of this information to commit email and account takeover fraud, transactional fraud, application fraud, etc. In the wake of the EMV rollout, $4 billion of counterfeit card fraud will be drastically reduced in the United States. Fraudsters won't walk away from that level of profit. They will simply commit other acts of fraud to replace that $4 billion. Application fraud is flourishing as one way to do so. When counterfeit magnetic stripe cards are no longer as effective, gaining a real EMV card is a great alternative that fraudsters will embrace. When you think about identifying applicants and authenticating existing customers, that is really one of the fundamental steps in fraud prevention. KYC, or Know Your Customer, requires that financial institutions do this. And so in addition to the fraud risk that financial institutions assume, they have compliance risks to deal with if they aren't properly identifying and authenticating consumers. Thin files or no credit bureau files often represent younger consumers who are just starting to establish a financial reputation, or older individuals who predominantly rely on cash rather than credit. As a result, credit bureaus have little information to help authenticate these consumers. Fraudsters have a methodology to establish synthetic identities. They may impersonate a cardholder to get a synthetic identity added to an existing account to establish some credit history. This appears to validate that the identity is a real individual. They may apply for new accounts using the synthetic identity. Credit bureaus accumulate data whether accounts are approved or declined. After a certain amount of activity, the synthetic identity can resemble one of a legitimate consumer, and at that point the identity is golden and new inquiries will continue to validate its existence. The credit bureaus recognize that there is a problem with the way that they accumulate this data and establish new records, and they're starting to use trended and alternative data to try to improve performance. Unfortunately, the fraudsters have a huge head start, and nobody knows how many synthetic identities already exist in the 3 credit bureaus' databases, or which ones they are. EMV rollout is really progressing in the United States. As the success of using counterfeit magnetic cards declines, fraudsters apply for EMV cards. We've seen this trend in several other countries that rolled out EMV before us. As one example, in Canada, application fraud losses increased more than 4-fold over the course of a 5-year period. In 2010, application fraud losses totaled 4.3 million in Canadian dollars. But by 2014, those losses had risen to 19 million Canadian dollars. Even though this application fraud trend has been noted in other countries in conjunction with EMV rollout, many financial institution executives in the United States aren't prepared for it. In research conducted in late 2015, it was clear that larger financial institutions are more apt to be familiar with the application fraud trend than smaller ones. But even in the largest category of $20 billion in assets or more, 38% of executives thought application fraud would remain flat or decrease. 52% of financial institutions between 1 and 19.9 billion in assets thought it would remain flat or decrease, while a whopping 81% of executives with institutions with assets less than 1 billion expected it to remain flat or decrease. Since executives were unaware of the trend, obviously they weren't preparing to combat it. And then we think about the move in financial institutions to digital channels. It's only logical that fraud is easier to commit in a faceless delivery channel. No identity documents have to be produced, and the fraudster doesn't have to act calm while looking someone in the eye and lying. While many financial institutions want to move activity to the online channel to reduce operating costs, application fraud rates online are 8 times higher than in a branch. We're still seeing relatively low application rates via the mobile channel to date. Many of the executives in this particular research didn't know about the contact center. Anecdotally, I've talked to executives and institutions who track fraud in their contact centers, and I'm being told that that the contact center is seeing fraud rates at about 4 times a branch. So nowhere near as heavy as online, and yet still 4 times heavier than in branches. From my own past banking experience, I recall a case where one man opened over 20 new accounts through our contact center using variations of an identity. The bank lost about $50,000 on that case, and I thought, shame on that crook. A few months later, he opened over 50 new accounts using variations on the same identity, and I thought, shame on us for not preventing this recurrence. So what can be done? When you think about risk mitigation opportunities, there are a number of things that can be done to help mitigate the risk with synthetic identities and manipulated identities. First, and this is what we did, link analysis is extremely helpful. It is common for fraudsters to slightly vary information and apply for multiple accounts. You know, they may use a common name like Robert. They might have one account that's Bob, one that's Bobby, one that's RL for a middle initial. I mean, they just change data slightly so that your customer information system doesn't realize it's the same individual. Using link analysis to tie together accounts opened with the same address, phone number, or other information can lead to better detection of application fraud and the use of synthetic identities. Any data field that helps link multiple accounts can help. Another strategy is to monitor behavior in the early months of new account life. Fraudsters often learn the bank's policies and they're very familiar with banking regulations, and they will let an account age before they try to commit fraud. Pay particular attention to dramatic changes in account activity just after it's no longer classified as new. Often the passage of time lulls the institution into assuming it's a good account, and they let their guard down. That's when the fraudster strikes. Monitoring activity early in the account life can help detect potential credit card bust outs, deposit or MRDC fraud, and a variety of other activity. On a side note, if there's little or no activity in an account, there may be an opportunity to expand the relationship to meet the customer's needs better, since the current account isn't really being used. So it's an opportunity for account farming as well. And effective account farming can lead to relationship expansion and lower attrition rates. You can also use product restrictions to help mitigate risk. Some financial institutions require that an account be opened for a certain period of time prior to being eligible for mobile remote deposit capture, as one example. I'll share one quick war story here. Last month, my husband came home from work one day. He manages a drugstore, and he came home. He was really not in a good mood. He told me about a man who had come into his store and stolen $2,500 in less than 10 minutes. What happened was this man came in, he bought $2,500 in traveler's checks and left. Less than 10 minutes later, he came back into the store. He told the clerk he had changed his mind and he wanted to return the traveler's checks. The clerk credited the $2,500 back to his card. Unfortunately, during that few minutes that the man left the store and went to his car, he deposited those legitimately issued traveler's checks to his DDA account, earning a profit of $2,500 when he returned them. Needless to say, my husband wasn't in a very good mood at dinner that night. Other product restrictions can help alleviate risk on new accounts. These include spending and withdrawal limits on cards, limiting funds availability on new account deposits, not allowing any overdrafts on accounts, or even requiring that payroll be direct deposited to an account or card. You know, it's important to understand that the concept of identity has really evolved and changed in recent decades. 100 years ago, most people lived in small towns or boroughs, and they were recognized by their friends, neighbors, and local merchants. They were known and recognized simply by their appearance. Everybody knew who they were. In 1936, the Social Security Administration first started issuing Social Security cards, and the purpose for those cards was to track workers' earnings, and to help calculate benefits for entitlement and benefit programs. Over time, though, financial institutions and all other types of businesses, many other types of businesses, whether they be educational institutions, whether they be healthcare related, started using that Social Security number to help tie an individual and recognize who they were. That Social Security number became a strong identifier of an individual, and it became universally used, even though that was not the intent. Most recently, digital identities have evolved, which can include many aspects, including biometrics, behavior, and even associated devices that an individual uses. There are a lot of questions remaining with regard to who owns digital identities, how they're best protected, how to recover when one is compromised. I mean, I literally could go on and on. It's essential to keep current as the concept of identity continues to evolve and to use many of these components as you authenticate people. In the next generation of identity, many aspects of our lives may be incorporated in determining that we are who we claim to be. Sometimes I think my smart home is smarter than I am, and I have more frequent flyer miles than I have dollars in my bank account. But all of these things related to our identities can help represent aspects of who we are. Using multiple factors rather than relying on one or two should improve fraud prevention results. Follow this trend and take advantage of it to help defeat synthetic identities. During this perfect storm of readily available data and EMV rollout, using all the data and security layers available is key to success. And then last, I want to really recognize that executives and financial institutions have very difficult jobs to do. They're competing with each other for customers while trying to mitigate risk and comply with a ton of regulatory requirements at the same time. Fraudsters don't have these challenges. They don't have to go to meetings. They don't have to explain budget variances or gain approval for a business case. They don't even have to pay taxes on their ill-gotten gains. While sometimes being forced into being reactive instead of proactive due to all the demands on your time, the job that you do in walking this fine line can help make a difference to the bottom line of your company and better protect your customers and possibly your country. Because we all know much of the money from fraud is used to fund terrorist attacks and other horrible things like human trafficking and other things. So at this point, I believe that we want to introduce a poll question that we would appreciate you taking a moment to respond to. We're only going to have the poll question up for a few seconds, and so I'm going to ask you to respond as quickly as you can. The question is, approximately what percentage of your new account applications do you feel are synthetic identities? And you can respond with one of these selections, 0 to 1%, 1 to 2, 2 to 3, 3 or more, or I don't know. After a few seconds, to allow you to respond to this question, I will turn the webinar over to Jeffrey.
Thank you very much, Shirley. Shirley spent some time going through some of the business issues related to synthetic fraud and application fraud in general. And I'm going to take the opportunity to dig a little bit deeper into some of the trends that could help us to better differentiate true identities and synthetic identities. And it's not a trivial problem in that in a given year, there are roughly 6 million new adults entering into our financial system every year. And in fact, all identities that are introduced to the system really have no electronic footprint prior to being in the system, which raises a large challenge as consumers are entering into the financial system, as legitimate consumers are entering the financial system. How is it to verify that they're a true consumer versus a synthetic? And what complicates matters even further is that we see a general trend or a change in the trends in how these identities are entering the system. 10 or 15 years ago, it was pretty common for the first record for a consumer to be a driver's license or voter registration or some sort of document indicating that a young person was beginning the transition to adulthood. But we're seeing credit cards being issued earlier and earlier, particularly as authorized users against their parents. So whereas 10 years ago, we would be looking for, oh, there's a driver's license, there's a voter registration. Now we're seeing a lot of header-only files, particularly, credit-only files, particularly in that young set. And then on top of that, if we're going to use Social Security numbers as some sort of universal identifier, over 20 million identities are associated with multiple SSNs. And this happens for a variety of legitimate reasons. So for example, it's not uncommon for spouses to share Social Security numbers, at least in the data record. And it's also fairly common for what we call fat fingering errors, where there might just be a mistake in data entry and ultimately result in multiple Social Security numbers. However, we also see that as a sign of fraud in that fraudsters often co-opt Social Security numbers by developing a synthetic identity. They will mix and match identity elements, and we'll often see Social Security numbers get inappropriately or fraudulently associated with new identities. Unlike typical identity theft sorts of fraud, there's also very rarely a consumer victim. So in most cases of identity fraud, a consumer will become aware of that fraud within hours, days, or weeks, a month at the most, when the bill surprises them at home. But in the case of synthetic identity, there's no one to call a financial institution or a retailer to say, hey, my identity has been compromised. And for that reason, these sorts of frauds can go on for years until the financial institution figures it out, or that fraudulent or synthetic consumer ultimately busts out and just kind of disappears, taking their profits with them. And because of the overlap in the behaviors and the profiles between true identities and synthetic identities, when these consumers do bust out, when they do go bad and pose that risk to the financial institution, it's not always clear that it was a fraud risk relative to, say, a credit loss risk of just a consumer that could no longer pay their bills. And that typically results in underestimates with regard to how big of a problem synthetic fraud is on their file. This slide summarizes why it's difficult. The next slide summarizes why it's relatively easy for fraudsters to create these identities. So for a fraudster, or for somebody who wants to generate synthetic identities, they can establish what we refer to as identity factories, manufacture synthetic identity factories, where there's really only a few simple steps. It's almost scary how easy it could be. Someone would persistently apply for credit with some sort of made-up combination of name, social, address, phone, etc. Now, if that synthetic application gets accepted, naturally, bingo, we've scored. That synthetic identity starts getting reported to credit bureaus and can all of a sudden become a full-fledged identity transacting and taking advantage of the system. More often than not, though, that identity will fail some sort of verification, some sort of simple check, and be declined. But then the synthetic manufacturer can go either onto the web or the dark web and start buying associated trades to append to that identity. And I'm not going to go through it here, but if you Google buy a trade line, you will find all sorts of resources which will enable you to essentially buy that information to turn a header-only declined file into what essentially is a full file. Once that synthetic identity is on file and looks and feels like a true consumer, that synthetic identity fraudster can then apply, transact, bust out, repeat. They can continue to do it. And it's very difficult for issuers, lenders, retailers, and so forth to detect this type of fraud. And often they detect it when that fraudster ultimately busts out. So we believe that synthetic identities are best identified at the identity level. So the credit identity, that's kind of well known. That's the credit bureau record that a consumer has. So when a consumer applies for credit, there's that file held at the three credit bureaus, Equifax, Experian, and TransUnion, that we can then verify that identity against. And that's pretty standard. But as we saw in the manufactured identity, that's ultimately also a key to the ability to create synthetic identities. So it's important to overlay non-credit sorts of dimensions to the identity. And I mentioned a couple a second ago when I talked about voter registration and driver's licenses, because it's much more challenging for that fraudster to go and create a legitimate looking synthetic identity. They can create the credit components of that identity, but by combining the credit components with the non-credit components, we can do a much better job of differentiating. Then we want to look at the contents of those identities. And we typically look at two different things. One is identity consistency. That is, for example, if we know that a social security number was issued in Iowa, is there some evidence that that identity either lives, or their family lived in Iowa at some time in their past? Essentially corroborating that the identity information on file is consistent with how that consumer is presenting themselves. By the same token, we want to look at identity uniqueness and intersection. We've seen synthetic rings that essentially use a photocopy machine to take different identity and trade line elements and create thousands of synthetic identities. And we tend to see repeating of many of those identity elements across different instances. So it's really important to say, is this identity both unique to other identities and are areas of intersection, areas that make a lot of sense? So for example, one area of intersection might be that a social security number for two spouses are on the same file. That's typically less risky than, say, two strangers in different parts of the country transacting under the same social security number. And finally, we look at identity emergence and identity transactions. In the case of identity emergence, we're really looking at how that identity came to be. How did it evolve? We essentially look at the biography of an identity so that we can determine if that biography represents something realistic or not. Because true identities typically evolve as a long game. We've got a lifetime to build that identity, to build different sorts of trends in the data and experiences. Synthetic identity tends to be a much shorter game, okay, where they're looking to really establish that credit bureau file really, really quickly. So we want to really look at how that identity emerges, to look for trends indicating that it's an authentic biography versus it has signs of suspicious growth in that emergence. And finally, identity transactions. How is that identity presenting themselves to creditors when they apply for credit or to retailers? So when a person is transacting with an identity, it tends to transact very differently for true identities compared to synthetic identities. And we'll dig into some of these trends in the next couple of slides. But what's key to it all is really looking at the full range of data. And the data that we bring to the problem is from our LexisNexis identity repository, which combines 5 different dimensions of data. First, what we often refer to as our public records data assets. What we're really looking at there are court records, property records, licenses, driver's license, and transactional elements of an identity above and beyond what they might be doing with their credit as measured by credit reports. We also do look at credit activity as it occurs at credit reports. We're typically looking at the identity information on those reports, what we would commonly call the header, which is the name, address, social, phone number, and so forth, to really look for trends and consistencies across those data repositories and then compare those to the non-credit data. We're always looking at customer identity searches. That's a customer transacting against their own identity. We can think of those as inquiries or searches or shopping behavior for a particular identity. We also have access to reported frauds from a variety of lenders through what we call the LexisNexis Fraud Defense Network. And finally, a series of commercial and proprietary databases. And those proprietary databases are summarized in the next slide, just really high level. I'll feature some of them. For example, business association records. When one is transacting and developing synthetic fraud, they're unlikely to file all the necessary paperwork to establish a business. Similarly, they're unlikely to attend college or have any evidence of college attendance. That's a lot of trouble for a synthetic identity to go through just to prove that they're an authentic identity. Similarly, registering a car or establishing a driver's license. These sorts of behavioral elements really add to our ability to differentiate credit-based synthetics from both credit and non-credit-based true identities. In the next couple of slides, I'd like to share with you a couple of trends that we've seen when it comes to drilling down and identifying these sorts of patterns. So, for example, synthetics don't have parents. It's hard enough to establish a synthetic identity. Synthetic identity fraudsters typically don't go through the trouble of establishing a family around that identity. And so in one study we did, where we worked with a major financial institution and they sent us a file of their synthetics, we found that 73% of that population didn't have any family. The way we're looking at family is looking at the full record of a consumer and find spouses, parents, children, cousins, and so forth by virtue of cohabitation and other shared sorts of relationships in our data. 73% of those synthetics had no evidence of family, as reported by a lender. We then took a similarly sized random sample, and it was extremely rare for somebody to exist in the United States and have no evidence of either parent, sibling, or child, or some other more distant relative. This is pretty much a smoking gun as to whether or not someone's synthetic or not. It's very, very challenging. Now, it does happen when we have an immigrant population that might not have those sorts of trends, but we do see that those sort of data elements evolve very quickly, because that person entering the country is going to start transacting both in terms of credit and non-credit. So, for example, they will establish a residence. And by establishing a residence, we will see those sorts of trends come to light and be able to differentiate them. So synthetics tend to not have family in our data. Similarly, we often see, and this is true of both true and synthetics, that when an identity is emerging, there's low verification, right? There just isn't a whole lot of data associated with that customer. But when we kind of look at that verification and compare it to other elements, so for example, is that identity transacting? Is that identity applying for credit and so forth? We find that true identities do far less credit shopping than do synthetic identities, because the synthetic identity is really looking to evolve in terms of credit. So if we look at the trend on the next slide, what we see here is inquiries per application SSN. So along the x-axis, what we're looking at is how many times did that SSN transact with the LexisNexis system? Essentially, was that identity used for identity verification or a fraud check or credit risk? And you see the typical trend. The more that an identity is searched against, the greater the risk. And what we're looking at here are consumers that have been seen at this address before. But what if we overlay a verification error? That is, we look at SSNs that haven't been seen at that address. Something is suspicious about that association between an SSN and address. If we can hit the space bar, we'll see that line. We see that shopping increases fraud dramatically. We're talking fraud rates in the 60% range if we have a verification error combined with some sort of credit evolution attempt on behalf of that applicant. Really good sign that there's either a synthetic identity going on here, or worse comes to worse, some other sort of fraud is going on. Next, we see ID tumbling. What ID tumbling is when a synthetic identity is established, it's typically done by combining, almost randomly, different kinds of PII information. In fact, if you go to buy a trade line, many of them advise to use PII information you've never used before. Because if you use PII information you've used before, you're likely to fail in your synthetic attempts. So what we want to look for is that sort of ID tumbling. And again, we can overlay that with how that identity is transacting to see if we can differentiate the emerging synthetic identity versus, say, a true identity who's transacting with that information. So, for example, you see kind of the low-risk consumer. And that is that they have only transacted with that address that kind of one time, or at least the last time they transacted at an address, it's the address we're looking at. But on the x-axis, we see that there's fraud associated with the number of different PII combinations that they've had. And it stands to reason that the more PII combinations they have, the greater the risk. And that alone is a very strong risk indicator. But if we look at the next line, these are cases where not only do they have a lot of combinations of their SSN and their other identity information, but the application we're looking at now is new as well. The fraud is what's through the roof. So again, looking at how that identity transacts in combination with other anomalies is really key to helping define those synthetics. We also see that short time on file and not reported by many sources is a sure indicator. This is kind of the classic definition of a credit bureau only file. And in fact, we see again along the x-axis how that identity is transacting. The three lines at the bottom are associated with having no credit headers, 2 credit headers, or 3 credit headers. And you see the incremental risk of both shopping and having those thin files. The risk is relatively low, but if you look from the left to the right of those 3 groups, the fraud rate actually relatively doubles. But if you find someone that's only on one bureau, that's somebody who's transacting and trying to build up an identity. It's no more risky if that person doesn't have a lot of transactions, a lot of identity transactions. But if that person with a single header is aggressively shopping for credit, a huge sign that some sort of identity anomaly is going on. You're probably looking at a synthetic identity in that case. And finally, we would look at source level risk. So just seeing who's reporting that customer has a lot of indication to risk. So if you can go to the next slide, I'm kind of define, I call these counter identities. And that is when an identity is established, is it established at a counter or is it done virtually? So a counter identity is one in which you go in person and say, hello, my name is Jeffrey Feinstein, here's my driver's license, and I'd like to fill out the following paperwork in order to do business with your institution. That's a counter identity, much less risky, compared to a virtual identity where in the safety of my home, with a computer and an internet connection, I can transact with my identity or really any identity I care to do in full. And in fact, you see that whether or not there's a counter identity or not is a determinant of the likely fraud rate. On the left, we see examples of counter identities. These are identities that are relatively more challenging to establish. So for example, a professional license, buying a property, going to school, declaring bankruptcy. Bankruptcy is a very large risk factor in credit risk, but it actually is a sign that somebody's a true identity. Voter registration and boat registration. These are identities that are far more challenging. If you compare them to the average, they're about half as risky when those sorts of identity elements occur just before an application, because it really indicates that that identity is transacting in a very likely, authentic way. Synthetic identities, or people forming synthetic identities, are typically not going to go to the DMV. They're typically not going to declare bankruptcy. They're typically not going to register to vote. In fact, when they do those sorts of things, that puts them at risk of getting caught. However, if you do a virtual identity like applying for credit and a new CB header is established just before that application, you're actually significantly more risky than an average population, suggesting that that header just came online and the person is now applying for credit. And of course, if you die, or if the identity dies just before, the fraud rate is through the roof. And in fact, we see evidence of synthetic identities. They're not really synthetic, they're deceased identities that are just popping up in homes. There is a home in Michigan that has about 40, 50 deceased people just transacting. And we see these sorts of addresses all throughout, where consumers move from across the country following their death and continue to transact. Now that's not technically a synthetic identity, but it's really in the same ballpark. And we use many of the same sorts of analytic approaches to find those identities. And then the ultimate source identity, driver's license, when we can confirm the driver's license against the DMV, the risk of that identity is almost zero. And here we're looking at index fraud rates, by the way. That is, a 1 means that the fraud rate is the same as the population. Anything below a 1 suggests that it's much lower, and a 0.04 index fraud rate is essentially saying that there's almost no fraud. And finally, the last source level one is around the date of birth, and we often find that dates of birth on the application are often after the issue date. In other words, somebody is applying for credit and using a date of birth that's younger than the person who that social security number belongs to. And if you look at the next slide, you'll see that the fraud rates are much higher when you see those sorts of date of birth anomalies. Essentially, when a young person is presenting themselves using a social security number that's much older than that young person could possibly be. So I hope I've made a good case for how we can use data and data trends to better differentiate true identities from synthetic identities. And really, the key is to combine a wealth of both credit and non-credit data in order to make that determination. So we really want to avoid relying solely on, say, a single credit bureau verification, because that usually is part of the process of emerging synthetics. We want to be really careful. In fact, a one bureau only verification, let me say that differently. A person who's verified in only one bureau is actually 10 times more likely to be a fraudster, to be a synthetic fraudster, than someone who's on all 3 bureaus. Similarly, solutions based only on, say, historical customer inquiries that are then used to predict future fraud and using that alone, those inquiries depend on the institutions that's collecting those inquiries and then informing those sorts of analytic solutions. And ultimately, those sorts of solutions are based on some sort of delayed feedback loop. Assuming the institution has tagged it correctly, the synthetic identification can be as many as 18 months, 2 years, 3 years later, because of the underestimation of the magnitude of synthetics relative to, say, authentic consumers. And finally, internal customer data is very, very useful, but it's really a limited view in the full representation of how a consumer is transacting with relation to their identity. Now, we are right now rolling these sorts of insights into many of our products and solutions, and they're all available right now on kind of a custom research basis and custom solutions, but we are working on the next steps to get these out into the marketplace, and I'd love to hear from you if you're interested in that. Before we move on to questions, I believe there's another poll question. Of your existing account portfolios, about what percentage of accounts were established by synthetics? You'll have about 30 seconds to fill this one out. I think we have some time for questions for Shirley and I.
Jeffrey, you're spot on. We've got about 10 minutes here. We can take some questions. I want to remind attendees, if you haven't submitted questions already, and a number of people have, take the time to do it now in the chat window that you see on your screen. I'm sure we won't get to every question today, but for those questions that we can't answer in the course of this session, we'll be sure to get responses back to you via email. So Shirley, Jeffrey, we get some questions coming in. Shirley, I've got one for you up front. Well, this is a great topic, synthetic identity fraud. In your experience, is this mainly an issue for larger institutions or are small to mid-sized ones being targeted too?
That is a great question. I believe that fraud has really changed over recent years. Just a couple of decades ago, the bulk of fraud targeted very large financial institutions that had branches on, they might have 50 branches in a large metropolitan area. So it was easy to commit fraud against those institutions. But things have changed. Number one, fraud now is hitting us from around the globe. It's not all domestic fraud. It's not local fraud. And so fraudsters recognize that financial institutions have a lot more accounts, so they are going to see a larger number of fraud attacks. At the same time, they also recognize that smaller institutions, mid-sized institutions, smaller ones, don't have all the fraud prevention mechanisms in place that large institutions do. So a lot of times we will see fraud initially hit and target those very large institutions, but if they put defenses in place to stop it, the fraud moves to other unprotected financial institutions. And it definitely moves downstream to smaller and smaller banks and credit unions.
Thank you, Shirley. Jeff, I got a question for you. Can you elaborate on non-state driving data? What is it and where is it sourced from, please?
Sure. It is sourced from places other than directly through the state DMV, and there's a variety of different commercial places to get that data. I don't have the specific sources available to me right now, but it is available for consumption. So it's typically places where you show your driver's license or register it through marketing sources, things like that.
Jeff, there's a follow-up to a point that you were making about Social Security numbers. How do you identify the Social Security numbers age in the system?
So there's two primary ways to do it, and unfortunately, one of them is going away. So a couple of years ago, I forget the date, but it's about 3 years ago, they started randomizing Social Security numbers. So that has made it impossible to do what I'm about to say. But the Social Security number or Social Security numbers are typically issued in kind of date order, such that you could determine from a Social Security number the range of dates with which it may have been issued, and you can usually get within a year or two. So just knowing a Social Security number, we can usually figure out the high level range. So that's the first way, and that way is going away with randomization, because going forward, as of about 3 or 4 years ago, they're just entirely random and you can't make that inference. The other method is simply look to see when that Social Security number starts transacting. That, of course, is a little bit more indirect and does raise some questions with regard to fraud. But that is the other way to do it. So seeing another question, I'll just kind of take another question at the same time, and that is, why do fraudsters use real Social Security numbers and not just fictitious numbers? It's because there's a large range of Social Security numbers that actually aren't valid Social Security numbers. We see those a lot. In fact, in one file of Social Security numbers, we found that a large number of synthetic fraudsters were actually transacting with just entirely invalid Social Security numbers. And another segment, we're using authentic Social Security numbers, but ones we've never seen before. It's awfully suspicious when you see a 35-year-old person using a Social Security number that's never hit our system, or has only hit our system once or twice in the past because somebody else had randomly used it. So typically, fictitious Social Security numbers or any synthetic Social Security number where it's valid or invalid is kind of easy to find when you look at the behavioral trends behind it. Does that make sense?
It does. Shirley, I want to bring you back into the conversation as well. I've got a question here both of you can answer. Is there a demonstrated link between hacking and synthetic fraud?
Well, to be honest, I am not aware of a demonstrated link. I think that it's just logical that all of that data available to fraudsters is being used as they commit fraud. There are many entities, financial institutions. Brian Krebs is famous for this, who kind of troll the underground on the internet and see this information from hacking attacks being sold, and then it is used subsequently often in fraud. But for me to say that X percentage of it can be directly tied back, I don't have a statistic I can share. Jeffrey, can you answer further?
From what I've seen from hacking, that's usually an opportunity to steal identities and information and valid information. So if my identity is stolen, it's very easy to transact as me, which is a true identity. So I see that as more a driver of identity theft than synthetics. I suppose it could be used as a source of different information, say valid information, and if you tumble it, you can create new identities. But it strikes me that that will get caught up in the true identity. So it's far more beneficial if you're going to hack successfully to think of that as identity theft and not synthetic identities.
Sure, they've got a question for you. One of the listeners is asking if you could please repeat the definition of account farming.
Sure. I apologize. This is a kind of sales jargon. On the sales side of your company, they often talk about hunting and farming. Hunting is someone who's identifying prospects and trying to bring in new business, while farming is the function of looking at existing relationships and trying to cross-sell additional products and make sure that you're meeting that customer's needs. And so my comment earlier was, if you have accounts, whether they be deposit or credit accounts that are not being used, they're sitting there, they were opened, if it was a deposit account, it might have been funded with a small amount of money, and it's sitting there week after week, perhaps month after month with little or no activity. That represents a consumer who possibly opened that account with the intent of using it for a purpose, and it's not meeting that need, so they're not using it. And so that can be an opportunity to reach out to better understand the need and perhaps cross-sell another product. On the other hand, it may be a fraudster who's letting that account sit there and age until it's no longer considered new. And, you think, well, we've had this account for 6 months, it's fine. And then that's when the fraud occurs. So it's just, farming is a sales term. I apologize if people weren't familiar with that.
Great. Thank you, Shirley. We've got time for a few more questions here, but I do want to remind attendees, if you have additional questions for Jeffrey, for Shirley, submit them now via the chat window that you see on your screen. And any questions we don't answer in the course of this session today, we will get responses back to you via email. A question for both of you. Do you have a feel over the past year or two of what percentage of total financial fraud is due to synthetic identities?
This is Shirley, and some research that we've done would indicate that it is in the 1 or 2% range. And while that sounds low, if you think of the volumes of accounts, that is a huge amount of fraud potentially. Jeffrey,
do you want to add to that?
It's really hard because they're not always tagged as such. So right now, we're really just looking at, we know it when we see it, as opposed to here's the problem, here's the extent of the problem. I do know that in our R&D, we're finding very large fraud schemes. In fact, we just found one that involved about 7,000 synthetic identities, all transacting out of a Philadelphia hub. Now, it's at the identity level, I can kind of talk about that, but I don't know the financial implications of that. It's much harder to then go and put a dollar amount and how lenders are flagging it and so forth. And given that it's so difficult to determine and so often misrepresented in lender data, it's a hard number to come by. I do believe it's a big problem. I just don't know how big.
Jeffrey, I got time for one last question. I'm going to send this your way. What is LexisNexis doing to work with institutions to mitigate synthetic identity fraud?
So we work pretty actively. These tend to be one-on-one sorts of conversations because we're finding that the problem tends to be very, very unique and flagged in such different ways or not flagged at all. So typically we've been working with files where either the customer was suspicious that something was going on, and in one case just recently they weren't suspicious, and we actually found a handful of synthetic frauds despite their believing it wasn't even a problem. In fact, we hit a synthetic fraud research against their portfolio and found a handful, 50 or 60 that were pretty clear synthetics. So right now, it's really kind of a one-on-one conversation to really find what's the best way, because it has to fit in the workflow, and it often needs to be baked into that workflow, and how to identify them. And once we do that, helping to minimize it is fairly straightforward, whether it be through the development of attributes or scores or something along those lines. I did see a question about whether those scores are adverse actionable, and these tend to be non-FCRA decisions in the fraud space. So while we could provide adverse actions or reason codes, we typically call them in the non-FCRA space, typically fraud solutions are considered non-FCRA sorts of decisions.
Very good, Jeffrey. Appreciate your time and insight today. Shirley,
Sure.
the same to you. Thank you so much for your presentation and for taking time to answer these questions.
Thank you very much.
Pleasure.
And of course, I also want to thank our attendees, each of them, taking time out of their day to attend our webinar. I do trust that today's discussion provided some valuable new insights and data points to enable you and your organization to be even better prepared to tackle this topic of synthetic identities. I look forward to seeing you again at one of our upcoming events. Until then, for Information Security Media Group, I'm Tom Field. Thank you very much.